Welcome to the Business of Soil Health. I'm your host, Patrick Smith, and the founder of Soil Upside. I'm really happy to have Emma Fuller with us today. She's co-founder at Fractal.ag and the head of data science and impact underwriting. Did I get that right, Emma?
You sure did.
All right, cool. Let's start by just tell us a little bit about Fractal's model because it's unique in the real asset investment space.
Yeah, for sure. Yeah, so we take minority equity investments in farmland. So break that down for folks that are not swimming in that terminology. Piece of ground, piece of actual farmland, we will take up to 45% ownership stake in partnership with the farmer. So the farmer that owns and operates that land will continue to own and operate that land and will have up to 45%. We get exposure both to the appreciation, and then there's an annual payment that a farmer pays on that portion of land. We can go into the details of that, but that's the fundamental structure based on a couple of things. One, we think farmers are the best positioned to manage that asset, right? To drive returns in a piece of ground. And this also meets a key need for farmers, which is equity financing. For those that are familiar with different types of capital stacks, equity financing does not exist in a sort of broad productionized way for farm businesses, right? You can get sort of bespoke different collaborations that you might get with high net worth individuals, but broadly, equity financing is not really easy to access.
Okay, so I'm going to walk through that a little step by step as somebody that doesn't live in farmland investment every day. If I understand this correctly, it's basically a sale leaseback model. Is that right?
Not quite. So sale leaseback model, yeah. So it's different than a sale leaseback model. A sale leaseback model, right? Investor will own outright an asset and then lease it back to a farmer. That can work. That often has either you are exposed to appreciation on the upside, right? That a farmer may have to sort of catch up to the market, or the sale leaseback might be willing to accept concessionary returns to sort of hold that flat, but you're not typically moving with the value of the asset through time. So instead, what we have is a minority equity investment. So we own 45% max of a piece of ground. We are in that investment for 10 years is the term of that agreement. And at the end of the 10 years, yes, the farmer does buy us back, similar to a lease sale back, but they maintain full ownership and control of that operation. So there's no other terms that you might end up getting in a sale leaseback where they sort of control the way that you farm or the way that you must operate or the crops that you grow. Not saying that there aren't sale leasebacks that are great, but this is sort of maintained structurally the ownership and management control for the farmer.
Okay, so help us understand this from the producer's perspective. They own a section, and they're like, I really am trying to find capital to invest back in my operation or buy additional land that's near me.
Yep.
They talk with you, and what does that arrangement look like for that section?
Yeah, totally. Yes, a farmer will often, a really common use case, say, is some ground that I've been renting for a long time is now going to be sold, right? So say 300 acres, and I don't have the cash flow right now to be able to pick that up. So how do I come raise that capital initially to sort of even maintain my existing operational footprint? So they'll approach us and say, here's a piece of ground that I've farmed, that I own and have sufficient equity in, right? So they have they can't have too much debt on that ground. So they own this piece of ground and they've operated it. That's sort of our sweet spot, is places that farmers have owned and operated for a long time so that we can see the asset performance, we can see the farmland performance. So we're not going in together on new ground, we're going in on ground they already own and operate. So a farm will come to that. The best sorts of farms, the piece of ground that we like to work with, our favorites, are either ones that have extremely high soil quality, right, that they've invested in themselves for a long time, and fields that typically outperform, right? So it doesn't need to be necessarily Class A, amazing prime soil, but if the soil is doing above average yields, even if it's a lower quality soil or soil that they've invested in, so now it's outperforming what the other sort of cohort would be, that's sort of where we look. We should probably mention, this is primarily focused on corn and soy, sort of large row crop operations in the US Midwest. So we're not in permanent crops, we're not in specialty crops, all that sort of stuff. So we're really focused on the sort of broad row acre operations where this need is particularly acute. So a farmer will come to us, we'll underwrite that land. That's really where my role functionally comes in. So we'll say, based on the operational history, we'll get performance data from the farmer about their yields, their cropping rotations, their practices. We'll look at the surrounding farmland market and we'll come up with our own valuation. We're not trying to win on valuations. We're not trying to underprice farmers there. We're super transparent. What we want to be doing is hitting where the market's at, right? We want to pay market rate for these fields. We're super transparent with that. And so we're not trying to hide anything. And then often we'll say, look, if this is our valuation, If you don't agree with it and you think that there are other relevant and material facts, you let us know. If we can see through third-party data, whether it's through, new markets that are coming online in the region, or a stronger performance history that we weren't thinking of, or X, Y, and Z about the local market, we can take that into account. And there are places where people have pointed out, oh, look, the depth to bedrock, or the depth to the impermeable layer here, or the way that water recharges in this layer. And then we can go back, grab that data and be like, oh, you're absolutely right. Like, we did see that. We missed that at that broad overview, but since you've just zeroed in on exactly what makes this region unique, we can then actually verify that through third-party sources. Come to an agreement. Farmer accepts our valuation and decides, yep, I want to do this. We make sure, of course, that they have enough equity in their own land, do debt and title checks and sort of all of that compliance stuff at the back end. And then we deploy capital, and it's theirs to invest in their own business.
Got it. So you're not actually going into new purchase. You're purchasing or getting a right to property that they already own.
Correct. Yeah.
Got it. But you're underwriting on the new property or underwriting on the current property?
The current property.
Got it. Okay. And if I understand right, one of the other major tenets of your model is that there's no restrictions on what the producers can use that capital for.
That's right. Yep. I mean, the producers, that most of them that we're working with, some of them have restructured a little bit to get out of variable rate or high, sort of restructured their debt load, but the majority have been focused on land purchases. So that's either new ground that has come up, or it's buying out land, rented land. And it's actually particularly interesting today that we're seeing the rented angle, particularly because the rental market is getting increasingly competitive. There's now starting to be like cash rent auctions, right? So as opposed to these for those that are not familiar with this space, most of these row crop operations maybe have a third to 2/3 on average rented ground. So rented land is a big part of the sort of composition of a row crop farm. Those rental agreements are often handshakes and often long-term sort of personal relationships, right? Many are involved with widowers who the farmer has passed on, the kids don't want it, and so they're sort of in the neighborhood, in the community renting. This is now getting depersonalized as folks continue to pass, and all of a sudden folks are seeing their rents sort of aggressively go up. And so being able to own the land rather than rent the ground helps control that really expensive. It's like the most expensive part of your budget is your rent. And so that's been a big push from a lot of farmers that we've been hearing from, is wanting to own rather than rent, to sort of insulate themselves from those sorts of exposures to increased costs.
Yeah, it makes a lot of sense. Another piece of your model, maybe the third piece that we're talking about here, is that you all have structures in place to incent soil health, building soil health, climate smart practices, that kind of thing. Can you talk a little bit about how you do that?
Yeah, for sure. So the big thesis here, right, is that investment in soil health, it does two things. It does both these co-benefits for climate and water, but it also fundamentally affects cash flow and productivity, which ultimately ends up in the value of the land. So the investor and the farmer wins by investing in soil health. I think this is a concept that we have talked about in a high level for a long time, right? This is not a new idea. You can look back hundreds of years, right, to thinking about soil health. George Washington Carver is like one of my favorite anecdotes, talking about cover crop and soil health and investment in the early 1900s. Like, this is not new. And it's not new even in the last 20 years, right? We've all been talking about soil health for a long time. But it's actually putting the rubber to the road and building a product around that and saying a farmer benefits and we benefit as an investor in that ground together if we invest in the soil specifically. So the way that works, which was your original question, is it's actually a pretty simple process at the top. And this was based on our own experience, having built carbon programs, having built other programs that try to develop these win-wins economically. Because we have this annual payment, a farmer gets a discount for every additional soil health practice that they do every year. So every year they have an annual payment, and every year, depending on the number of practices that they adopt, we discount proportionally. So it was simple and designed to like sort of fit in specifically into this landscape to sort of drive change at scale for a couple of reasons. One, these practices we put together have a sort of a set list of automatically qualifying practices. So not every practice is appropriate on every acre, and not every practice leads to unambiguously good outcomes. But there are some practices that we all can feel pretty confident about based on the scientific literature, based on experience, that we've all seen consistently drive things in the right direction. These are things like cover crops, no-till, diverse rotations, edge of field, no fall applied nitrogen. All of these things move in the direction of improving soil health and reducing water quality loads, which both improve the production in the field and reduce regulatory risk, as those are sort of two big areas that we focus on that goes with the land. And then when we think about actual adoption of practices, yes, no-till adoption might be maybe a third of acres, but that's probably on a rotational basis. And If you go to no-till and cover crop, the number of acres goes so down so far. No-till, cover crop, and a diverse rotation, you're talking like maybe a million acres, maybe. So being able to stack additional practices and help all farmers, not only if they're already doing one, to adopt several, and recognizing that many of these things are done rotationally and it takes time to experiment. So there's no requirement that they commit for 10 years. We want to see that level overall in our entire portfolio rather than in any specific piece of ground, because again, that's sort of the level that we're investing is across a landscape of soil rather than any specific field that we go super deep, because I think that is not going to actually be as impactful as this much broader scale across the landscape.
So again, to sort of simplify this.
Yes, please.
What kind of discounts do you offer for practice implementation? Can you quantify that a little bit?
Yeah, so we offer a 0.2% discount on that annual payment. So that annual payment, I think right now is somewhere around like 5.6%. So typical. So we take the valuation, and then 5.6%-ish is sort of where it is now. It's been 5. It sort of moves depending on the macroeconomic conditions. And then every additional discount is 0.2%. So that, depending on the value of the land, depending on sort of those sorts of things, can end up being somewhere around $20 an acre per practice. And so as you stack, right, if you're already doing no-till and you add cover crops, now you're looking at $40 an acre. If you're doing no-till, cover crops, and diverse rotations, you're looking at $60 an acre. So it's meant to be a material stack that many farmers are going to have to pull together to sort of be able to offset the entire cost of adoption. But a big chunk is what this was designed to be.
What's the max?
The max number?
Yeah.
I think that folks can max out at 8. I think a total of 8 practices. We have one farm who's got 6, another that's got 5 that we're already working with. So we have some pretty deep adopters, and many of those are like, we're going to do all 8. So the sort of competitive angle of that is pretty neat to see. But it's everything from, those sort of like they talked about, but rotational grazing is another one. So incorporating livestock, which is a bigger lift if you don't have livestock already in your operation. We also add additional discounts for continuity. So if you do cover crops for 3 years in a row, that's essentially a double discount for both the cover crops and the multiple years, and the same for no-till, both because we know that those practices specifically done year over year have so much more benefit to the soil and it's so much harder. So we offer additional discounts there.
So 8 practices, each of them at 0.2%. We're really talking about a total of 1.6% discounts. Yeah. So if it's at 5.6 now, you're talking about 4% at the end of the day as a sort of floor, right? It's amazing, particularly given interest rate.
Yep. And that's the sort of designation, right? Is that we want to be sitting in between what those interest rates are to make this useful as a capital tool for farmers.
I'm really interested in this relationship between practices and actual soil health outcomes, because cover crops are not necessarily going to be successful, particularly in the first year or 2 or 3 that they're being used. And I'm curious if in your model you looked at underwriting actual soil health metrics as opposed to practice metrics. Yeah,
that's a great question. So I'm watching that space really carefully, and having built a carbon model previously, I have gone through many rounds with what we can and can't measure and on what timescales. The biggest challenge with measuring outcomes immediately, right, especially if you're adopting a new practice, is that those outcomes are going to be lagging. And so that means that you put a lot of risk on the producer for this first couple of years to say, okay, well, prove it to me that this is going to work. So you could flip that and say, well, then you're taking on a lot of risk as an investor to say, oh, well, you're going to pay someone a discount for 3 years, but you're not actually going to get anything out of that. We think we mitigate that risk pretty substantially because we're dealing with practices that have such a robust body of literature, right? We're not, if we were going to take on, say, some of the new biological inoculants, super cool, very excited. New seed treatments, new technology that really does represent the cutting edge. I'm excited about those, but we would need a lot of demonstration about their average effects before we feel comfortable underwriting those and adding those at discount. Cover crops, like, we're there. And the places where cover crops don't work, for example, and that's a good one because it gets called out a lot, are places where it doesn't actually do a job on the farm, that no farmer is interested in adopting cover crops on their own. Our discount actually is meant to not cover the entire cost because we want to make sure that we're pushing for farmers to adopt practices that they think will work on their farm and achieve additional co-benefits. So we think about cover crops. We talk a lot about the climate smart angle of it. It increases carbon sequestration, also builds soil health. But what it's also doing is, in many cases, it's helping with weed control, right? And the way that it helps with weed control is that it actually germinates and grows to sufficient biomass. That's also when it helps with carbon sequestration. If you're going to put it in North Dakota, where your growing season is really short after corn, so you get the corn out and it's frozen, it's very difficult to get that cover crop in the ground. That's a place where people are like, we shouldn't do cover crop. You're super right. No farmer is out there being like, I'm going to put $60 an acre worth of cash on this ground to freeze. Like, that's not what they're doing. So it actually works really well, I think, in partnership with farmers to say you choose the practices that you can implement and that are a good fit based on what you think on this field in your area. And that's why we don't require any specific menu of practices, because different farms, even in the same county, can have very different soil types, very different water regimes, very different crop rotations. And this is obviously something I get very excited about. But even just, in Iowa and then southern Minnesota, relatively close when you think about the entire Corn Belt. But again, just the difference in growing season meant that cover crops works great for them and may not work for folks farther north. So again, that's why we really focus on, and we sort of initially talked about outcomes, but these are practices that we have strong evidence for across time, and that we partner with farmers to make sure the practices will actually frankly work alongside the production capacity. And that seems to hit 95% of these areas.
I want to highlight one of the things that you talked about as part of your underwriting, which is that the yield outperforms for the same soil type for their peers. And I'm curious if you think that that is actually also a proxy for soil health.
Yeah, for sure it is. I mean, that's, at the end of the day, what we expect to see is that those crops will grow healthier and faster and more on the same percent sand, percent clay, percent silt. So you can start to see and benchmark these fields across the landscape and say, okay, this field is in a top percentile, regularly outperforming. Like that's ultimately what we care about, is that ability to get resilient yields across time. And what's so nice about soil health is that that goes hand in hand with improved carbon sequestration, improved water quality, increased biodiversity, and all these other co-benefits. We can say this does these good things and it delivers improved outcomes economically. And so we don't need to be concessionary. We don't need to be philanthropic. We can start to unlock additional sources of capital, which feel really critical if we're going to actually deliver regenerative as sort of the default mode of agriculture across our landscape, is really accessing that market rate pool of capital to deploy.
Okay. You mentioned that in addition to outperforming on yield, a couple of the great things are outperforming on cash flow and productivity. There are different productivity metrics across Midwestern states primarily. And I'm curious if you see soil health metrics are being incorporated into productivity metrics or land valuation.
Yeah, not yet. Not as much as I want to be seeing it, I think, is the frank answer. Still, by far the dominant way to do land valuation, besides seeing what comparable sales are, is to look at your productivity index. So in Iowa, it's called CSR2, the Corn Suitability Rating 2. And that is, the dollar per CSR2 point is a very common way to benchmark your land. So a 90 CSR2 versus a 70 will go for very different outcomes. The progress in actually incorporating that, I think, really ends up coming down to asset performance. That actually getting asset like yields on these fields is not easy when you're doing a third-party sale typically. And so I think that's one of the ways that it ends up, and getting the actual specific practice information off these fields is difficult when you have a third-party transaction, and that's been an impediment. I also think, frankly, that sort of appraisers and extension have so focused on this. Folks publish guides to how to set rent, guides of how to sort of do a farmland sale for folks that are not either farmers or professional land managers themselves, and all of those center on CSR2. So it becomes a sort of self-referential circle. And so I think what we need to see, and we're starting to see, I think there's a few folks, I think LandCorp is thinking about this, I think the Delta Institute is thinking about this, and a few others is sort of trying to bring appraisers along for that journey. But I think our thoughts here are that when you look at cash flows, you see it, right? And you can even almost be agnostic, like you said, to soil health and not care, right? As long as they're not sort of dumping synthetic fertilizer on these fields, but soil health will continue to improve the cash flows. And because the cash flows relate to the land value, you'll continue to see that as cash flows, as folks sort of value farmland for their fundamental value. So we're sort of seeing that maturity, which is sort of the underpinnings of being able to shift to a soil health mindset, frankly. But it's taken time, for sure.
So the last sort of major piece of your model that I think is important for us to understand is, how do you make money?
Yeah. So the way that fundamentally the fractal business model works is by continuing to deploy capital to additional deals. And then we make a small management fee for every year that we have capital deployed out. So that's sort of typical of real asset investors, is those sorts of two streams of funding. And so really our model hums when we get to scale, right? So this is not like a $50 million sort of process. This is something that needs to scale 100 million, 500 million, a billion, right? Really deploying and moving capital to meet farmers' needs at that scale of operation, much rather than these sort of very small initial funds.
So I think what I'm hearing is it's very much a standard real asset investment model where
exactly
you make money both on the deals through the annual payments and the selling of the property eventually, and as an asset manager, you make money on the capital that you're deploying.
Yep.
Let's dig into the first two, the annual payments and the eventual sale of the property. I think the annual payments are relatively straightforward, and the fact that you provide a discount based on climate smart practices is pretty incredible. But how do you make money on those annual payments if, I mean, the numbers that we're talking about between 4 and 5.6%, like they're lower than prime right now. So
yeah,
like, tell me about how you make money on that.
Yeah. So actually those annual payments go straight back to the investors, the LPs in the fund, right? So that's actually passed through. So the LPs returns are a combination of both those annual payments and then the ultimate appreciation on the land value, which you mentioned, which we can talk about the exit too, about how that capital actually is returned at the end of 10 years. Fractal will make money both on the deployment of those assets, and then there is an annual fee that we charge investors on that. And so that requires like a capital pool. I think, somewhere in the hundreds of millions is sort of where we need to get. So we're new, we're starting, right? We need to initially deploy and prove out the model that there is demand from this from farmers. It actually meets a farmer need, and that it can we can do the deals that we say we can do at the scale that we say we can do, which is what we're focused on right now. And then will require us raising additional pools of capital for us to grow in size to be able to hit those sort of management fees that can be a self-sustaining fund. So we think our minimum fund size at this point is much less than 50 million based on how small and lean the team is, but that will continue to grow as we want to sort of increase scale, and those will grow proportionally.
Got it. So those annual payments are flowing directly through to your LPs.
Yep.
And essentially for them, that's just extra sort of icing on the cake, because the bulk of the returns are going to come through the sale of the asset.
So it's actually probably about 50-50. I mean, it will depend on many things. And obviously, we're all talking about prospective future returns, of which we have no guarantee and nothing like that. So to be very clear about that. So this is all based on sort of what we've seen in historical is typically farmland, across the last 30 years, whether you look at USDA or you look at, there's a data set called NCREIF, which is for private institutional owners. Those show that appreciation, it's between 4 and 12%, sometimes as high as 20%, depending on which vintage you've gone in on. But in general, it's been very steady and very positive across time. So that is typically pegged at somewhere between 4 and 5% is the appreciation across 10 years on average. And then the income rate forms structurally the other part of that return. So it's roughly 50-50, but that's something that we can sort of tune in our product up and down, depending on the needs of the farmers, the macroeconomic cycle, right? So you can, if you expect appreciation to be lower, you end up tuning up the income rate. And if you expect appreciation to be more robust, you can tune that income rate down. So that's sort of part of what we're really focused on, is these structural adjustments in the model, so that we're not building bespoke financial products for every single case that comes along, because we just don't think that's scalable. So that's really the sort of breakdown of that. And so investors like that because they not only get an appreciation over the long term to this land asset, but they also get sort of an income inflation adjusted payment every year. And so that's particularly appealing to many folks, just even on that structure of the way that the money comes back to them.
And how does that impact the producer? Does that mean their annual payment goes up, possibly down?
Yeah, so it's indexed to the value of the land. So if land is going to depreciate, then their income rate, the nominal amount that they would pay would also go down. If land appreciates, then also that nominal amount goes up. But it's set structurally in the contract at the beginning of those 10 years. So we're not renegotiating that every year. That is like a known quantity. And so a farmer can underwrite that risk themselves and say, you know what, I think I'm comfortable with farmland. From what I've seen in my area, where I think we are in a commodity cycle, I can feel confident and make that choice myself. You have all the information on the table. And that was really our focus, was like, we don't want to be surprising folks down the line in year 3 or year 5 about this. This is a long-term partnership, because ultimately, to your point about exit, What we want to be able to do is at the end of those 10 years, be able to roll over that investment to a new investor, right? So we can be a really long-term partner in that farmland and not need to exit at 10 years. Of course, we can't commit to that right now. We're not there, but we sort of articulate that that's where we want to be. And so we want to set this up right so that we can continue to partner with that farmer indefinitely in that piece of ground.
Great. We'll talk about that in just a second. But to finish the annual payment piece, does that mean that you do an appraisal every year on all the
Good
property
question. That would be very expensive and very difficult.
Right,
so we
exactly.
index to local third parties on the intervening year. So we do it every couple of years that we'll do an appraisal, but yeah, not every year.
Got it. Yeah, let's talk about the exit, because I would imagine producers would be most concerned about that. Like, who's going to own my property at the end of 10 years? Can I buy it back? If so, does that make sense on a tax basis? Do I think my revenue and income is going to support that? Who else is going to come in potentially? Like, talk about that.
Yeah. So again, we're minority equity investors. So what we have the ability to do is force a third party sale at the end of 10 years, at the end of the contract. That's the only sort of right that we have there, which just maintains and requires and protects the liquidity for the investor, right? So we have to have a way to be able to exit for the investor, because that's the commitment we make on that side when we bring capital in to the fund. That 10-year exit can do a couple of different things. The farmer can buy us out. So typically so if a farmer has invested in another piece of ground, for example, often it will be like a refinance, because equity is built up in that asset that we've invested in with that appreciation. So they may refinance and buy us out. The worst case scenario, right, which we don't want because we want to focus on farmland in farmers' hands, right, is if they needed to go to a third party sale, right? And so if that third party sale were to occur, we're second in that stack. So first, obviously, we pay off any mortgage debt that they had, and then we get the share of the appreciation. So the farmer also realizes the value from that sale, right? So we would get, say we're 40% on that piece of field, we get 40%, the farmer gets the remaining after they settle with their debt provider. If a farmer bought a piece of ground with a Fractal equity, their balance sheet is in a stronger position than if they had just not bought that piece of ground. And so that was, again, really important to us structurally, is that even in the worst case scenario, even if a farmer decides, you know what, it's not worth it to buy you out, I'm just going to sell this piece of ground, that they would be in a stronger business position than if they had not taken Fractal out. So and the other thing I should mention is that actually after 3 years, a farmer can exit at any time. So a farmer has liquidity control after those 3 years, which is another way structurally we wanted to make sure that farmers maintained the ability to control this, rather than investors necessarily being able to yank the ground out from under them, which is often a challenge when folks partner with high net worth folks on a sort of custom by custom basis. And so if for that liquidity control, a farmer pays a small premium up front. So they essentially give a little bit more equity to the investor in order to have that control so that they can exit at that time. And that sort of reimburses the investor for that slight increase in risk from the farmer's perspective.
And so when you say they have the option to exit, they have the option to buy it back from you.
Buy it back. Yeah, exactly. Yeah, or buy us out. Yeah.
So I'm hearing two options. I'm hearing the option of the grower buying it back, and I'm hearing the option of the third party sale. Is there an in-between option where you continue to hold it, or you bring in other investors behind you to take over your share?
No. Yeah. So if we exit, yeah. So we can be in it, or the farmer can have us exit, but we're in it for those 10 years once we've made a commitment to be with that farmer. So because we have minority equity position, we don't have any control about bringing in additional investors or anything like that. The only thing that may happen would be a new agreement at the end of term, for example, that the original investor, the original Fractal fund wants to exit and a new capital vehicle wants to enter. But that would be it would be an exit event that would be closed out from the original Fractal agreement, and then the farmer would have full control about whether or not they wanted to enter into a subsequent agreement. So there's no follow-on, there's no sort of strings attached beyond the sort of 10-year. And again, that was meant to be very modular and very clear, because this is, again, like a single building block in a capital stack for a farmer, right? A single tool in the toolbox for a farmer to sort of pull and say, I need debt capital for this, Fractal equity for that, in order to put together sort of the right investment profile to continue to grow my business.
Got it. Yeah, it makes a lot of sense. And I'm assuming you've structured it that way because there's no current market for fractional ownership shares, essentially. This
is a new model completely. Yeah. But we're hoping, though, that that's an appealing one. And we've had sort of early conversations with folks that, want to see it proven out. But I think the combination of diverse exposure coupled with asset performance across time, I think, is a really powerful de-risker for many folks that want to be in farmland to be able to have that. So we're we're excited to be already having those conversations, frankly, this early.
Those conversations meaning what?
Hearing from very large capital providers that they might want to pick up if there was interest after those 10 years of an exit to maintain a long-term capital partner to re-enter into that farmland.
On a minority basis.
On a minority basis. Same basis, exactly.
Yeah, that's really interesting. It's like you guys are creating essentially a new asset category, potentially.
That's right. Yep, that's the hope, which, first of a kind is always a good time. But I think that's, again, like what we need to start driving these sort of fundamental alignments between soil health and economics. So that was the way that we figured out, man, we can make this work.
I think that's a really great overview of the various pieces of your model. I'm curious about company stage. So you've mentioned that you're not at the sort of full fund stage, you're still early, but you've closed capital recently, you've announced that, and you've deployed several $1 million already. So talk a little bit about stage that you're at, how much you've raised, how much you've deployed, kind of what you see on the horizon.
Yeah. So we've just announced our first close. We raised a little over 15 million in our first close, aiming much higher than that, somewhere 50, 75, sort of depending on the market. We'll see, depending and also on the need, frankly. Sometimes folks push you to close a fund much earlier so you can start the next one. So we'll see. So raised 15 on that first close. Expect to have a few additional closes in the next couple of months, just for a few folks that couldn't quite get in on that timeline. And we've deployed over 8 million, which has been pretty exciting because I think initially when we showed up, many folks were compelled by the model and the sort of theoretical fit, right? It meets a farmer need. It has really compelling sort of profile from a return profile in theory. Can you do it? Do farmers want this? Like, you're telling me farmers want this, but do they? Will they show up? Will they work with a new financial actor? Can you underwrite? Can you deliver appropriate market adjusted valuations? Can you do it fast enough? All of those sorts of rubber meets the road questions. And so it's been really satisfying. We launched maybe about a year ago publicly with a press release or something like that. And the farmer demand has been pretty incredible, right? I think our pipeline is millions and millions and millions and millions of dollars of demand for this from farmers. And this is demand that is across commodity cycles, which is pretty interesting, right? So we started and launched in a period where there'd been a lot of government assistance and commodity prices were very high. And so there was a lot of money in farmers' pockets because of that. And now we're shifting to a commodity cycle where that's not the case, right? We have very low commodity prices. It's going to be some lean years for the next couple of years. And we're seeing actually the demand and the product shift, right, according to where we are in the capital cycle. So that's been pretty exciting to see the farmer need, just frankly, just straight up, that equity need is not met. And there is no way for them to raise that kind of capital. So either, a piece of ground that they have farmed for decades and someone's going to sell, they're going to just watch it go, right? They're going to have to sit out. And that's sort of a once in a lifetime event. Farmland does not turn over that frequently. And so when something sells and it goes, it does not come back very frequently. So that's been very compelling to hear, not only know that that's true in a broad sense, but then in a very specific sense, and we're very specific farmers on specific scenarios that we're able to provide and deploy that capital quite quickly. So it's been pretty exciting, I think, on that front. But the farmer need is there, and so we're continuing to focus on the fundraising side to make sure that we can meet the farmer need for capital. So we're not going to be forced to turn folks away just because we're limited on the capital front.
Yeah, the challenge on fundraising, I'm interested to dig in there a little bit because you're both first-time fund managers and you have a brand new capital deployment model, like this new asset that you're creating. So despite this overwhelming demand from farmers that you're seeing, it sounds like there may have been some, or there may still be some challenges convincing institutional capital to deploy into this. So where have you raised capital from? What are you seeing on that side?
Yeah. So the main folks that we've got right now have been really, I would call, like institutional family offices. So these are folks that are sort of familiar with institutional level investments, and perhaps in other vehicles they do make those sorts of institutional commitments. But I think really the appetite has had to be for first-time fund managers, right? So that's the biggest, I think, hurdle, is the first-time fund managers. And so there are folks in that space that are more willing to take a chance on a new model. And that's actually what's particularly catalytic about folks. So it's typically folks that have an impact bent to them initially, right? That are willing to think about a first of a kind model, and first time fund managers. Because again, that's where the innovation is going to come from in this space, right? The folks that are doing traditional models to traditional sources will continue to be traditional, right? So like investment is not known for being highly innovative. And so those folks have been where we've seen the biggest traction initially. I think, this is all public, but like Builder's Vision, for example, continues to be a leader in this space, I think seeding many great new ideas. And so they got the thesis immediately. And so we're ready to go immediately to say, this makes total sense. This is a new segment. So let's do it. And we've had several other additional folks follow on from there to say, okay, now that you've done a couple of deals with that warehouse capital, we can see that and we're willing to jump in. So we've had some really amazing folks. And these tend to be folks that sit at that intersection of caring about impact, caring about regenerative ag, but also really fundamentally understanding the farmland asset profile, that really understand the value that can bring to their portfolio. And so really understand that sort of market rate impact connection. But it takes time to have those conversations. And like you're finding here, right, it's a new model. It's an asset class that not many people are familiar with. And it's got this impact angle that you may be more or less excited about. And so it requires many conversations to get familiar with it, to get comfortable with it, to understand it, because it is new. It's not something that you can easily sort of be like, oh, it's commercial real estate, or, oh, it's, sort of philanthropic concessionary returns for deep impact. Like it doesn't fit a bucket very cleanly, which can require many more conversations to figure out how it fits in their own strategy.
So it sounds like your LPs currently sit at that intersection of the Venn diagram of impact and first-time fund manager investors.
Yep, but also very much interested in the scale. So I would say that many of these folks are interested not just even in the potential of this fund, but in seeing it grow. And so I think that's also what makes them pretty unique about the folks that we've brought on board so far. And the folks that we're continuing to talk to are those ones that sort of see that potential for the ability to grow and for this model to work not only at this scale, but also, at 100 million acres sort of level of scale.
Yeah, let's talk about scale, because it seems like that's one of the kind of guiding lights for your model. In some sort of pieces of the regenerative movement, there's tension between commodity production and regenerative ag. And so can you talk just about this idea of scaling regenerative impact through commodity focus?
Yeah, I should maybe just share a little bit of my background because I think it's relevant here, which is that my husband and I have a 15-acre organic vegetable farm. We have a local CSA, 50 folks at local farm stand. We live on an island outside of Seattle. We sell exclusively locally to our community. We have 2 farm managers that we employ. We use horses, like we're Portlandia through and through. So I think about food systems across a huge spectrum, from at home. How do I run my own farm business at home? Like, how do I do this? How do I make sure there's sufficient equity for our 2 farm managers who are incredibly skilled farmers? How do I make sure that there's value in this business for them? And then I step back and I think about, how do we do commodity at, right? Like, so I love talking about this, and I just share that to say that I care deeply about how do we figure out this puzzle, and I don't think there's one mode of production that fits everywhere. So anyway, that's just a little bit of background to say that I think, like you've said, there is tension, right? That the farm that I run at home is the future, is the answer. That's certainly like the emotionally romantic, the most romantic notion for sure, that we could have farms like my farm dotting the landscape, providing food to local businesses and to local schools. And certainly we are trying to make that work. But at the same time, I think there's always going to be a place for very large scale commoditized agriculture, and especially on timeframes that matter. The next 5 to 10 years, right? If we think about any of our climate or impact goals that we very ambitiously by 2030 or even by 2050 at this point, commodity agriculture is not going to disappear. It's not going to go away in 5 years. It's not going to go away in 10 years, right? So to just ignore that piece of the puzzle from an impact lens, I think essentially gives up on most of the acres in farmland today. It just gives up. It says, like, I'm going to focus on these 100,000 acres of deeply regenerative farmland, which is amazing. And they're going to do amazing things. And you're going to give up on 150 million acres, right? And it's just that scale, I think, is 100,000 acres is a lot of land for any person to stand in and look around. And so it feels like a lot. But when you zoom out to the level of the continental United States, you realize that it's just like a tiny fraction. And part of what has made so many deeply pervasive challenges in agriculture is related to the scale that it's at, right? Any given field has a relatively very small responsibility for the amount of nitrogen that runs into the Gulf of Mexico. But the fact that there are 100 million acres of those fields all doing a tiny amount is what has driven this huge problem. But that also means that the solution to that problem cannot be on an individual field. It has to be on 100 million acres. And so you need to develop solutions that hit that segment. And I think, so that's sort of what has compelled me to be in commodity ag. And I left my PhD after I got my PhD and jumped into industry, and actually jumped into commodity ag even as we were starting a business, because I thought this is the segment that if we can solve it here, like this is where we need to apply solutions for urgency and scale, even while we push forward on reimagining how food systems work, reimagining how markets work. Again, like there's tension and it's tough because there's only so much capital in this impact space. So it often feels like you have to choose between one or the other. And that's a big part of why we think that our market rate scale focus is so critical, right? So yes, we do require some impact funding to get us up off the ground because we need to prove out the model, we need to prove out a track record, but we see a very clear path to graduating out of that sort of impact pool to free that capital back up to continue to work on some of this more transformative work that needs additional de-risking so that we can start to access and leverage that market rate. So again, that's been my focus on this, and that's what gets me so excited. And because it's intellectually hard. You have to be really thoughtful about how you do this because there's no easy answers. And I think that's the other thing, is that if there were easy answers, we would have solved it, right? It would have been easy, it would have been done. And so I think we're in a world of trade-offs and we're in a world of ambiguity. And that's the place you have to be okay being in order to make change in these very large systems very fast.
I couldn't agree with you more with the centrality of commodity ag as a key area of focus to actually affect change at scale. One of the other pieces here, and that's not just soil health, it's also producer livelihoods. One of the things that I've seen is that commodity producers, particularly row crop producers, are operating at such a fine economic margin that once they're able to get a little more economic flexibility, it gives them a lot more flexibility in terms of what are the crops that they're growing, what are their management practices, and allows them to be more creative and gives them a lot more discretion over their own operation. So I'm curious, what role do you see Fractal playing in that economic and livelihood transformation for producers?
Yeah, that's a really nice framing of that. I think I've seen that many times in individual producers, but I don't think I'd had sort of zoomed out to sort of think about it at that sort of conceptual scale. So I think that is essentially what happens every time we make an investment, right? Is that a farmer is starting to think, okay, how do I strategically invest in my business, as opposed to just trying to patch things to make things meet and make sure that I can borrow enough in my operating line to buy the seeds to then pay off the, sort of going from debt provider to debt provider. It's stepping back and saying, okay, strategically, how do I invest in my business? Is it a new grain storage facility that helps me access prices at a different time of year? Or is it sort of, buying out this piece of ground so that it's not a big moving piece for rent every year? And that's a tough negotiation. And instead I have more control over that structurally, which lets me then sort of reinvest. And so the farmers that we work with also are farmers that are in that mode, right? That are already starting to think and look for creative solutions. So definitely we're a capital provider. So we can't take credit for the creativity and the ability for farmers to do that. But many of these farmers are stepping back and saying, we have a really efficient commodity operation. I don't think our returns are going to come through continuing to optimize, right? Now it's like, how do we diversify? Can we add livestock? Can we double crop? Can we, so you start to see some of this diversification that's happening on these farms. And I think that's the other thing that I feel so privileged, is being in a front row seat and watching that sort of diversity of strategies too. That when you zoom out and you see 180 million acres of corn, it all looks the same. But all of those businesses and all those people that are running those businesses are all very different and all have very different local conditions. And so I think you're absolutely right. But again, I don't want to take credit for all the good work the farmers are doing, but we get to be that capital. And so we get to see those very creative decisions up front.
Long term, do you see an opportunity to bring your community of producers together to sort of learn collectively?
Yeah, I mean, we're already actually doing that with some of the farmers that we work with. Yes, for sure. And I think the other thing that we see as an opportunity is continuing to identify other programs, whether it's additional sources of capital or it's new tools, right? Because now we are, and this is not only, I think, something that we did in our previous roles when we built carbon programs or other ag tech solutions in other businesses, but now structurally, because we also were invested in these farmers' success, we're invested in the land being successful. We also have a structural incentive to want to make sure that these farmers are improving and being successful financially. We all are on the same team structurally. And so yes, for sure. And we're really excited to see many of the sort of collaborative partnerships that are springing up to try to be central hubs to bring farmers together. So yeah, absolutely. And actually didn't mention this, one of our discounts that I was really pleased to put in was a farmer gets a discount if they are someone who's been adopting regenerative practices for a while. If they go to a knowledge sharing event and they share their own experience, that can qualify. And so that was really important to me because so often farmers are asked to make a lot of time sacrifices and share that really hard won advice, which is not compensated in any way, but is critically important for the entire industry and the entire landscape to improve. So yes, not only do we want farmers to be pulling together to understand and share information, but we also want them to be sharing the hard won experience that they've gotten also.
Yeah, so great. Really enjoyed talking to you, Emma. Really appreciate what you're doing at Fractal. It plays such a critical role. Wish you all the success. I'm curious if you have any final thoughts that you want to leave folks with.
Yeah, I think the biggest thing is that we're out of time. Just the urgency here for addressing these goals, addressing farmer need it's now. And so the sort of continuing to wait, continuing to study, continuing, and this is, I think, broadly true about the climate smart ag in general. This has been so well developed at a large macro scale that it's frustrating to continue to see hesitancy in deploying capital along these lines. So just encourage folks to get out and actually do things instead of talking about it.
Well, I think you have an amazing model that has a lot of potential to deploy capital. So thank you for your work.
Yeah. Thanks for the time.
Thanks for the conversation.
Yeah.
Thanks for listening to this episode of The Business of Soil Health. Our goal is to explore how new financial tools may or may not support producers' stewardship of their soil. We love hearing from listeners, so don't hesitate to reach out with any suggestions or guests you'd like for us to feature. And don't forget to subscribe or leave a review on your favorite podcast platform.